So, so we are looking at computation of personal income tax in relation to employment income. That means if someone has an employment, how do you tax those their income? Maybe the income they are deriving from their profession, from their vocation. How do you tax it now? So you add the income together, the earned income. What is earned income? Earned income are income that is derived or that is derived from activities that involve your active participation. If you are doing a job, that is earned income. Are we together now? If you are doing a vocation, that's earned income. Now, after you have calculated your earned income, if there is benefit in kind, benefit in kind, are with you. Benefit in kind. So, what I'm calculating now is for the old way of calculating personal income tax. The old method of calculating personal income tax. That's what we're looking at. That means in your exam, it is the year that determines. So if the year in which we are calculating the personal income tax is 2026, are we together now? What are you going to use? You use the new tax, the new computation of calculating personal income tax. But anything, because the new tax law takes effect on 1st January 2026. So, but if you are asked in the exam to calculate, you are given a calculation for 2025, 2024, and backward like that, you will use the old way of calculating personal income tax. So we are looking at the old and the new. This is the old method. That means before January 1st, 2026. That is what we are looking at. So if you are given a question before, and the date is before January 1st, 2026, this is what you are going to, this is the format you are going to use. So benefit in kind. Now, what is benefit in kind? Benefit in kind is there are other benefits other than cash. Other benefits other than cash. Let's say you are into an employment now. They now give you an house. Your employer give you an house to be staying. Are we together? That is benefit in kind. There are other benefits other than cash. Instead of them giving you, adding the rent allowance to your salary, that means they are now paying for, or they are giving accommodation. So benefit in kind. So you can calculate benefit in kind in two ways. Look at it now. You can calculate it in two ways. Now look at it now. Benefit in kind now. This is how you calculate benefit in kind. Now we are going to look at the question, but let me explain benefit in kind. Now, if your employer is the owner of that property that is being given, that property can be a land, it can be a house, an accommodation, it can be a car, it can be a generator. Are we together now? Now look at it now. If the employer that provide that benefit in kind is the owner, that means it will be 5% of the cost of whether it's accommodation, whether it's car that is providing to that they have provided to you as benefits. 5% of it is regarded as what? As an income. So it is what we call benefit in kind. It will be, you write, let's say the amount is 1 million. So 1 million, 5% of 1 million will be, I think, 50,000 naira. So you write benefit in kind will now amount to what? To 50,000 naira. So, but if the employer, that means the person that the employer that provides that the item of benefit in kind to the employee, that means to that employee now, and is not the owner. So when the employer is not the owner, not the owner. That means the amount in which they paid for the rent. That means if they are not the owner, that means they rented that apartment for you. So if they rented that apartment for you, the amount at which they rent it to for you, it is what would be regarded as benefit in kind. So that benefit in kind will not be amount that they paid for that rent. But if it's a car now that they rented a car for that employee, that means it will be regarded as income, and the amount in which they pay for it to be rent, for them to rent that uh, that car will not be regarded as benefit in kind. You can see that. But when the employer is the owner, that means the benefit of in kind for that employee now will now be calculated as 5% of the cost. Now, but if the cost cannot be determined, if you cannot determine the cost, maybe the cost is not given, you will use the market value of that asset. That means if you can determine the cost, you know how much is this item cost in the market, how much are they selling this item in the market. So the amount at which that market is being sold at the market, that will now what you use, the 5% of it. So the 5% can either be on cost or market value. But if you are not giving cost, you look for what? For the market value. So the 5% of the cost or the market value will not be what we call the benefit in kind. But if the owner is not the owner, if the employer of that person is not the owner, that means the amount they paid for that item of benefit in kind, whether car or house, will be, or generator or furniture, will be regarded as benefit in kind. Do we understand that now? Do we understand what I just explained?
Yeah.
Okay, let's move forward now. After benefit in kind, we have unearned income. Unearned income and income that you earn from activities that you are not fully involved in. Maybe you put your money in fixed deposit account now. They now pay you interest for it. That interest, you didn't do anything for it. You just put your money there, the money just accumulated. That interest is regarded as unearned income. Or if you have a property now that you rented out and you are collecting rent on that property, the income or the money, that rent you are getting from that property is called unearned income. Royalty can also be regarded as benefit in kind. So dividends can also be regarded as benefit in kind. So when you now have all this, you now add it together and you now have your total income. So after having your total income, you now less your tax exempt. Tax exempt. So you less your item exempted from tax. What are the items exempted from tax? So your item exempted from tax are your pension contribution. So your pension now is not being taxed. So the pension contribution that the employee has contributed, that is what you know as pension contribution. It is not the pension contribution of the employer. You know, in ODRS now, the ODRS will pay 10% of your basic salary and 10% of your salary, while you from your own salary you pay 8%. That 8% is your pension contribution that is not taxed. Are we together now? So pension contribution, you have National Housing Fund deduction. You have, so you less it from it. So you less it. You have your National Health Insurance Scheme. National Health Insurance Scheme. You also less it. They are items exempted from tax. Now, life assurance. Life assurance. Maybe you have life assurance that you are paying premium on. Premium that you are paying on life assurance is also what? Exempted. So if you have a premium that you are paying, whether on a monthly basis or on an annual basis, is also not is also part of items exempted from tax. So after that, gratuity. Gratuity is not tax. Gratuities are also part of the item that is not tax. So after you have deducted all this, you now have what we call your gross income. Your gross income. Hope you can see the board. Your gross income. Now let's now try to manage the board. So after getting your gross income now, you now go to what's it called? You now go to the consolidated relief allowance. You less your consolidated relief allowance. That's what we call CRA, consolidated relief allowance. And your consolidated relief allowance is calculated as follows: as the higher of 1% of gross income, of this gross income, or 200,000. So anyone that is higher, so of your gross income. So after getting your gross income, that means after you have less your total income from all these items exempted from tax, you now have your gross income. After having your gross income, you now less your consolidated relief allowance, which we call CRA, consolidated relief allowance. And your consolidated relief allowance is calculated as follows: as the higher of 1% of gross income, or 200,000 naira. So whichever is higher is what? Plus 20% of gross income. So when you add it together, you have your consolidated relief allowance. So your consolidated relief allowance is the higher of 1% of gross income, or 200,000, whichever is higher, plus 20% of your gross income. So you now have your what's it called? Your consolidated relief allowance. So this will be your consolidated relief allowance. So you now less your consolidated relief allowance from your gross income. You less your consolidated relief allowance from your gross income. Now, when you less your consolidated relief allowance, this is your gross income from your consolidated relief allowance. You now have your chargeable income. You now have your chargeable income. Now, after having your chargeable income now, you can now apply your tax table. Now, to now determine, because your tax will be paid, your tax will be paid, your tax will be based on your chargeable income. Your tax will be based on your chargeable income. So after having your chargeable income, the tax paid now, you can now calculate the tax paid. So tax payable now, you now apply the tax table based on your chargeable income. So you now have your chargeable income now. Let's say the first 300,000 at 7%. The next 300,000 at what? At which percent? At 11%. Just be adding 4 to it. The next 500,000 at 15%, whatever you have will be your tax. So this will be the tax. This will be the tax. Okay, don't let me. So you have the next 500,000. Add 4 to it. That will be 19. So whatever you have the next 1.6 million at 21%. So when you get to 19, just add 3 to it. That will be 21%. Whatever you have. So and above anything above 3.2 million, will be at 24%. So this is your tax payable now. Sorry, this is your, let me just say, this is your tax payable. This is your tax payable, and this is the calculation of your chargeable income. So that means you have to divide your chargeable income into all these 300,000. What's it called? If your chargeable income is like 600,000, it will stop here. First 300,000, the next 300,000, it will stop here. So if your chargeable income is let's say 700, if you remove 300 from 700, it will remain 400. So you go to this one. Is 400 greater than 300? Yes, you write 300. So if you add this 300 plus 300, that's 600. 600 minus 700 is remaining 100. So here, instead of 500, you write 100. So it will stop here. So whatever you have after applying the rate is what you have as your tax. So you now have your tax. Are we together now? You now have your tax. So your tax. So this will now be your tax payable. If they have deducted any withholding tax from any of this income, maybe on any income, maybe interest, before you get your interest now, they could have deduct tax. They could have deduct the tax. So what you receive is the net of what the net. That means after deducting withholding tax now. But when you are calculating the unearned income here, you put the gross. You calculate it based on the gross. We are still going to look at that. So by the time you are now calculating your tax payable, you now remove the withholding tax that has been deducted. What do you mean by withholding tax? They are tax that has been deducted from source. So if a company is paying you dividends now, they could have withdraw or deduct the withholding tax from the dividends that will be paid into your account. So less withholding tax. So from the tax you are supposed to pay, you now have the final tax liability. So this is how to calculate for your employment income now. Now let's now go to a calculation now. Are we together? Let's go to a calculation and let's see how to solve for this calculation now. Now, that calculation is in page 86. The practice question 1, 86. Any question? So let's go to the question. The question is on page 86 of our material. Page 86. Page 86, practice question 1. 1B. 1B. So they said Chief Daniel Kokoro, Chief Daniel Kokoro retired from one of the federal ministry in December 31st, 2019. 2019. See, from this now, you should know that it is the old computation of personal income tax that you use. Yeah, thank you. He said he has paid a gratuity. Sorry, he was paid a gratuity of 2.5 million on January 1st, 2020. On the 2nd of January 2020, he secured an employment with T-Scott Nigeria Limited as a finance manager with a salary of 6 million per annum. He is married with 4 children. Additional information provided in respect of his new employment is as follows. What is his new employment? As the finance manager in T-Scott Nigeria Limited. Now, they said his official car cost the official car cost 5 million in the open market. They said the company paid an annual rent of 1.2 million on his official residence. We should know that that official car given to him is what we call benefit in kind. You know, I told you that the benefit in kind are they are benefit other than cash. That means they are benefit that companies give to their employee that is not cash, that is not salary. Now, let's go to 3.3 now. They said he has a life assurance policy with Adope Insurance PSC with 600,000 naira sum assured. His monthly premium is 5,600. Now, you don't forget that the items exempted from tax now, we have life insurance premium. It's the premium that we're after, not how much was insured. So they said he contributes 8% of his annual salary as pension under the Nigeria Pension Act. Now they said he has an aged parent and spent 60,000 naira per annum for their upkeep. He said his other statutory contribution are National Health Insurance Fund 10,000 naira per annum and National Housing Fund 10,000 naira per month and National Housing Fund 150,000 naira per annum. They said compute the income tax liability for the relevant year of assessment. So what is the relevant year of assessment now? What is the relevant year of assessment? When did he secure? You know, his payee, his employment benefit, what's it called? His employment income. So his what's it called? His relevant year of assessment will be what, 2020? Because as you are collecting your salary, is it not immediately they are calculating tax on it and deducting it? So it's not like a trade that they wait for the preceding year basis before they tax you. So we are still going to look at trade income. How to calculate it is you need to do some things. Is quite so his year of assessment, because his employment income is what is 2020, because that's the year in which he secured the what employment. So you will write the name before you solve any calculation. His name is what? You write it, Mr. Chief Daniel Ro. So what they say we should do, they say we should calculate is what? So computation of personal income tax liability for 2020 year of assessment. So naira sign, naira sign. So what do we go to first? Now we know that is the old tax computation we are going to use for it. Old tax computation, because it's year 2020. So I told you that if you are to use new tax computation, it will be what? It will from 1st January 2020 upward. So anything before 1st January 2020, because 2026 is not going to, you are going to use the old computation of personal income tax now. So let's now look at it now. What's the first thing based on that format? The first thing you pick are the what? Are the earned income. So let's go to the earned income. We have earned income. Under the earned income, we have they say he has a salary. We have gratuity, because he retired from an employment and he was given a gratuity of 2.5 million. So we have gratuity. So how much is his gratuity? How much is his gratuity?
It's not 2.5 million.
2.5 million. Yes, you are right. 2.5 million. Sorry. We have how much is his salary for 2022, because he now got a new employment as a finance manager. They're now paying him salary. How much is his salary? They say per annum. So if in the question they gave you per month, divided by what? By 12.
But if it is by the total number of months.
By the total number of months he has worked for that year. How many years has he worked? Look at it now. How many? He said first it was in January that he started. So it will use the 12 months. Are we together now?
Yeah.
So if it is, let's assume that he started the work in 1st March, and they say his annual salary is 6 million now. That means you cannot write the whole 6 million for it. So from March to December is how many months?
9 months.
No, March, 1st March. That's 10. Any month that you are starting 1st or 2nd, you start from what? You first start from counting from that month. But if it's 31st of March now, you will start counting from April.
Okay.
So because it's 1st March, it will be March, April, May, June, July, August, September, November,
November,
sorry. What's it called? I said 1st March. March, April, May, June, July, August, September, October, November, December. That's 10 months. So that will be 10 over 12 times what? Times 6 million. So whatever you have, that's what is going to be his salary for that year. But in this question, he started our work in 2nd January. So you start counting from what? From January till December. That is 12 months. So if you do 12 over 12 times 6 million, it will still give you what? 6 million. So you don't need to bother about that. That will give you 6 million. So how much the salary will be what? 6 million. So that's the earned income now. Now, do we have any other earned income? No. Now we now go to the benefit in kind. There is no any other earned income. So these are the items of earned income. So let's now go to benefits in kind. So I told you all that benefits in kind are what? They are benefits in kind are what? Are benefits other than cash. So what are the benefits other than cash that they gave him?
Car.
They gave him a car. They gave him an accommodation. Now, the car, it was not stated that the car was rented. Was it stated that it was rented? That means it's the organization that owns the car. They gave him an official car. So, and they told us that the cost of that official car is what? 5 million. Because they didn't rent it, assuming it was rented, the amount at which they rent that car will be the benefit in kind. But because it's an official car that costs, that means the company are the one that purchased that car, or that the one that owns the car. So it means that the benefit in kind will be how much? Will be 5% of the cost. They have given us the cost of the item. They said the cost is what? 5 million. They said the official car cost was 5 million. So the benefit in kind, which is for official car. So what's the cost? So to calculate the benefit in kind, the amount at which should be subjected to tax, it will be 5% of the cost, which is 5 million. What's 5% of the cost? 5% of the cost will be how much? 5% of 5 million is how much?
5% of 5 million.
That's 250,000. So we have another benefit in kind. What's the other benefit in kind? They gave him an what's it called? An accommodation, right? They gave him an accommodation. They said the company pays an annual rent. That means if the company is not the one that owns that property that they have given to him, that means it was rented to him and the company is now paying 1.2 million naira for that rent, for the rent. That means that's benefit in kind. Are we together now? Now, I've told you that if the company are not the one that owns that property that they have given to the person to be staying, that means the amount at which they have paid for the rent will be the benefit in kind. So what's the benefit in kind? Official resident. So how much is the official resident paid? 1.2 million. Now, assuming it is the company now that owns the house in which they have given to that employee, they will not be paying rent. That means for that one, we will determine the cost of that building and now calculate 5% of the building is what we look for as benefit in kind. But because they are not the owner, they have rented the accommodation for that employee, Mr. Chief Daniel Kokoro. So the amount they have paid is the benefit in kind. Are we together now? So let's move now. So is there any unearned income? There is no any unearned income. In this question, there is no any unearned
income.
Unearned income is not there. So dash. So let's add it together. So 2.5 plus 6 million plus 2.5 million, 6 million plus 250 million plus 1.2 million. That will give us what? 9,950,000. That's what you have. So this 950,000 naira is the total income. Are we together? So what's the next thing based on that format? The next thing is to less our item exempted from what? From tax. Item exempted from tax. So that's our next thing.
Okay.
Item exempted from tax. So let's look at the items exempted from tax now. So what are the items exempted from tax? If you look at it, we say pension contribution, right? So let's calculate the item exempted from tax. So what are the items that is exempted from tax? What are the items exempted from tax? We have one. We have pension contribution. So what's the pension contribution? They say he contributes 8% of his salary. What's his salary? 6 million. This is his salary. 6 million. So what's 8% of his salary? That 8% is 4 In next class, please make sure you have calculator. 480,000. So another item exempted from tax is national um, housing fund. National housing fund. From that question, what is his national housing fund? You are not following the question. No. His national housing fund is 150 per annum. So it is per annum. So for 150. So we give 150 as his annum. We have national national uh, national health insurance fund. Now his national health insurance fund is 10,000 naira per month. And how many months did he work for that employment? How many months? He has worked what? 12 months, from January to December. So it's 12. Now if he has not worked for a complete for if he has not worked for the 12 months in a calendar year for 2020, you prorate all this now. But he has worked for 12 months, so that will be 10 times what? 12. That will give us 120. 120. Now let's move forward. Now what is his other? What are the other? What's it called? The other tax exempted from tax. Item exempted from tax that we have. Do we have any other one? Yes, life assurance premium. Life assurance premium. How much is the life assurance premium that is paid? Life assurance premium. It's not the amount that he assured, it's the amount of premium that is paying on a monthly or on an annual basis now. So based on that question, how much is the premium that is paying? How much? That means you are not following. He's paying 5,600. So 5,600 he has times per month times 12. So how much he has paid times 12? Oh yeah, what would that give us? We are not following at all. It will give us 67,200. 67,200. Now don't forget that gratuity is also part of the items exempted from tax. Gratuity is part of the items exempted from tax. So gratuity. So how much is the gratuity that he received during that year? He received a gratuity of 2.5 million. So it's part of it, 2.5 million. So let's add everything together. So if you add everything together, what do you have? So everything you have here, you will now less it from the total income. So if you add it together, that will be 3,317,200. That is the total items exempted from tax. So you now remove it from this 9,950,000. So if you remove it, what are you going to have? What are you going to have? Now, what are you going to have? You have 6,632,800. That will now give us our gross. That is now our gross income. Now, after calculating our gross income, we now go to our consolidated relief allowance. So you now remove the consolidated relief allowance from the gross income. So before then, let us calculate our consolidated relief allowance. Consolidated relief allowance. So less our consolidated relief allowance. Consolidated relief allowance. So let's calculate our consolidated relief allowance. So let's calculate our consolidated relief allowance now. After the calculation of the gross income now, let's now calculate our consolidated relief allowance. So consolidated relief allowance. So I told you that consolidated relief allowance is the higher of 200,000, or let's say 1%. That's what I wrote there. 1% of gross income. So what's 1% of gross income? So what's our gross income? 1% of gross income. So what's our gross income from this now? Our gross income is 6 million.
It is 8.5.
6 million. No, it's 6,632,800. So 1% of our gross income is that should be 1, 2. So it will be, our gross income will be 66,308. Now, or 200,000. So which one is higher between the two now? So it is 200,000 that is higher. So we'll pick 200,000. So it's 200,000 that is higher. So plus 20% of our gross income. So our gross income is 6,632,800. 6,632,800. Now, what's our gross income now? Let's press the calculator. Let me pause the video. Someone should press a calculator there. Now, after I have calculated our gross income is 6,632,800. Now, we now calculate our consolidated relief allowance, which we call CRA, consolidated relief allowance. And consolidated relief allowance is the higher of 1%, of gross income. Our gross income is 6,632,800, which will give us 66,328 and 200,000. Which one is higher between the two? Is 200,000. So plus 20% of our gross income. Our gross income is still 6,632,800. So when we now add the higher between the 1% of gross income and 200,000 plus 20% of gross income will give us 1,526,560. So from there now, after getting our consolidated relief allowance, we'll now remove the consolidated relief allowance from our gross income. So let's imagine that our gross income is A and our consolidated relief allowance is B now. So remove A from B. That means 6,632,800 minus 1,526,560. What do you have? So it will give us it will give us how much? That will give us 5,106,240. That is our chargeable income. So after getting our chargeable income now, we can now proceed to go to our tax payable. Let's now calculate our tax payable. Let's calculate our tax payable. Now, tax payable. Now, tax payable now, we now look at the tax table. We have first 300,000. Now you look at it now. Before you write the first 300,000, you look at this. What do we have our chargeable income is 5 million. Is 5 million greater than the 300,000? Yes. So you write 300,000 at what? At 7%. So 7% of 300,000 is how much? That's 21,000. That means we are trying to break this 5,106,240. We are trying to break it into the tax table. So now, if you take 300,000 from this amount, the remainder, the balance, is it going to be more, or is it going to be more than the next 300,000? Yes. So you have the next 300,000 at 11%. So 300,000 at 11%. That means 300,000 times 11% will give us 33,000. Now go to the next 500,000. Now if you add 500,000 plus 300 plus 300, that will give us one. 300 plus 300. 300 plus 300 will give us 600. Now 600 plus the next 500, that will give us 1.2. Is 1.2 greater than the 500? Yeah, sorry. 300 plus 300 will give us 600. 600 minus this is still going to give us, I think, around 4 point something. So 4 point something is still greater than the next 500,000. So you write the next 500,000 at 15%. So that will give us 500,000 times 15 will give us 75,000. Now we now go to the next 500 based on the tax table I've given. The next 500. So the next 500, before you write the next 500, 300 plus 300, 600 plus 500 will give us 1.2, 1.1. 1.1 minus 5.1, 5.1. It will still give us more than, it will still give us around, I think, around 3 point something million. Are we together now? Or 4.1 million. So 4 point something million. So it's still greater than the next 500. So you write the next 500, write it in full. So at how much? At 19%. So 19% of 500, that means 500,000 times 19%, it will be 95. So let's now add what we have here. 300 plus 300, that's 600, plus 500, that's 1.1 million, plus 500, that will give us 1.6 million. 1.6 million minus 500 minus 5.1 million approximately. Now the next amount we are looking at is 1.6. Is it greater than the balance after deducting 1.6 million from 5.1 million? What is the balance are we going to have? Now the balance is going to be around 2 point something million. It's still greater than 1.6 million. So you can now write 1.6 million in full because the balance is greater than 1.6 million. So at what? 21%. So 21% of 1.6 million is 336,000. 336,000. Now let's now move forward now. Now if you had, now which is the last amount that we are looking at now, 300 plus 300 will give us 600, plus 500 will give us 1.1 million, plus 500 will give us 1.6 million. 1.6 million plus 1.6 will give us 3.6 million. Now, the 3.6 million, remove 3.6 million from what's it called? From 5,106,240. What are you going to have? The balance is what you are going to have, because that's where your tax rate stop at. It stop at 24%. So what's the balance of what's it called? Of 2.2 million. That means I said 2.2, 3.2 million. Addition of this will give us 3.2 million minus 5,106,240 is going to give us 1,906,240 at what? At 24%. So that's the balance, because that's where it will stop. It's going to give us this now. So if you give us this, what's 24% of 1,906,240 is going to give us 497,497.6. So now the tax paid, now you now add all these together, that will give us the amount of tax payable now. So the tax that the person is going to pay is going to be addition of this now, which is 1,017,497.6. That is the tax paid. Did he pay any withholding tax? No, there is no any withholding tax paid. So you not remove any withholding tax from it. So you have tax payable. So assuming there is withholding tax, you now write withholding tax. Assuming there is withholding tax now that he has paid, so you write withholding tax here minus withholding tax, but there is no withholding tax. Are we together now? There is no withholding tax in this question now. You didn't pay withholding tax. So withholding tax is the tax that is deducted from what? From source. That means that it is the tax that is deducted from source of an income. So now, because in this question now there is no element of withholding tax there, so there is no withholding tax. So the withholding tax is that. So the amount that we pay is still 1,017,497.6. That is the final tax liability. Final tax liability. Any question?